Well, hello again. We are now on Module 3. Module 3 is titled Financial Management. At this point, you should have completed Module 1, which was about business planning, and you most likely worked with your mentor, start working on your business plan, learning what you did from the first module. The second module was on credit. We learned about personal credit, business credit, and how they are different, how they're similar, and how they impact your ability to get funding, which is not in all circumstances. And now we're into my favorite module, financial management, module 3. We're going to go through some really valuable information. You may find it intriguing. You may not be that excited about it, but it's important information if you want to be successful in raising capital for your business and in general for operating a profitable business. So let's go ahead and get started with financial management for a small business. All right, so our agenda is full of important topics. We're going to talk about benefits of financial management, budgeting, bookkeeping, financial statements, business financing. Then we'll kind of wrap it up with some key points to remember and the summary and evaluation. Remember, I'm going to be going through this at a pretty quick pace, at a high level. You have your participant guide, you have your mentor who's going to work with you on applying the different skill sets and the activities, and of course, applying it to your business. So our learning objectives include explain the concept of financial management and its importance to a small business and its owner. So in other words, why is it important? Why should you pay attention to this module? Why is this information going to impact your future? Secondly, we want to identify financial management practices, rules, and tools commonly available to small businesses. And thirdly, explain how financial management practices, rules, and tools work. Just a quick word of caution, often we'll work with early stage small businesses. And I think that the fallacy or the mistake is, well, this doesn't apply to me yet. My business isn't open or I'm a startup. But that's really just the opposite. We need to build a strong foundation of financial management to be able to increase our probability of success, both in profitability and of getting financing. Furthermore, we're going to explain financing basics for a small business, including startup financing, financing for a growing business, financing working capital, and financing fixed assets. As we've mentioned in the earlier modules, it's important to realize that there are different sources of capital, and each source of capital has its own underwriting criteria, what it takes to get approved. Well, mixed into that statement is the fact that depending on how you're going to use the money will influence where the money should come from, because not all types of capital can be used for all circumstances. So the benefits of financial management: you can reach your goals by making good decisions, by knowing your profitability, forecasting your growth, planning for diversification, new product lines, reaching new markets, and preparing to access capital, which is right at the center of our target, isn't it? So in terms of budgeting, budgeting is one of those items that, whether it be at home or at work, a lot of us don't get excited about, but budgeting is important. And so discussion point number 1 is on budgeting. You're going to work with your mentor using your participant guide. If you look on page 8, you're going to work with him or her on reviewing the categories, which categories you use, talk about how you're tracking your expenses and how it applies. So you can pause this or continue the video, but you're going to want to work with your mentor on discussion point number 1, budgeting, which is page 8 of the participant guide. Okay, moving on to bookkeeping. So bookkeeping is a critical component of financial management. It's an organized process of tracking all of the income and expense transactions. So this isn't just simply saying, oh, I have a business bank account, so everything's tracked there. This isn't saying, oh, I have a business credit card or PayPal and everything's going through there. So this is the basis for all financial management, business decisions, financing, taxes, owner's draws, and retirement. So bookkeeping is an essential element of operating an effective small business. Now, the nice thing, there are 10 steps, and we're going to go through those briefly in terms of setting up a bookkeeping system. So number one, we need to get business accounting software. My experience, and I used to teach it, was Quickbooks, but no way do we have any financial interest in Quickbooks, and Quickbooks has many competitors. But you need a software like a Quickbooks where you can record all your income and expenses. And typically, most bank accounts will have an interface with Quickbooks where the data can be imported in. It used to be, we'd have to manually type in every transaction. Now it's much more easy. Number two, we need to open a separate business checking account. So the business checking account should be under the business's name. If you formed an LLC, a C Corp, or S Corp, and you get an EIN for that, and you take that paperwork to the bank and you open a business checking account. If you're running a sole proprietorship, normally you would file for a DBA at your county courthouse. You take that to the bank and you open a separate business checking account. You want to have a separate checking account, and many of us have multiple. You might have one for payroll, one for general operating funds, but at least one business checking account that's truly business. Number three, reconcile your checking account. If you're using QuickBooks or something, a software like that, it'll aid in that process. Number four, of course, you want to track sales, and that links closely to number five, deposit sales. We see some clients that operate a cash business or a partially cash business, so the temptation is to not record all sales. Well, separate from the taxation and legality of that, which I won't speak to, now you're really misrepresenting most likely the size, the success of your company, and the profitability. We need to write business checks for business expenses. Number six, get a separate business credit card so you're keeping business and personal expenses separate. Number eight, pay your business expenses first. Number nine, and number nine is a great one because you're going to see this when we get into module 4. We're going to ask you for your business's profit and loss, sometimes called income statement and balance sheet, 2 key financial statements, which we're going to talk more about today as we go through the module. And a lot of small businesses kind of shrug their shoulders. Well, I don't have that. Well, that's the output, right? If we were using the software like a QuickBooks or something similar, then generating those reports becomes pretty simple, just a report. If we're not tracking properly, then it becomes almost an insurmountable task to be able to keep producing these financial statements. On number 9, I probably should have highlighted it because you can imagine if we're going to go to a bank and look for financing. Of course, there's different types of financing, not just bank financing, but if we're going to go to a bank, that banker, or in general, any lender, is really going to want to see the profit, loss, and balance sheet. We cannot make the excuse, oh, we're a pre-launch business, we're a startup business. That doesn't apply. That's a financially illiterate statement to make. Now, obviously, profit and loss is showing income and expenses, and you might not have any income yet, and maybe we're so early in working with you don't even have any expenses yet, but we need to have that set up. And if you're following these rules that we're talking about of keeping business expenses within the business, then you probably will have expense. Just if you bought QuickBooks, you had an expense, didn't you? There's a great example. And then number 10, paying yourself correctly. And we could have a whole discussion about that. But we strongly encourage, and you can visit with your CPA about this, but we strongly encourage you to set up a payroll account for yourself and pay yourself as soon as possible, even if it's small in the beginning, a W-2 paycheck. This is going to be a little bit shocking or contrarian to you, but we encourage people to not be self-employed. And what I mean by that is you can own a company and be an employee, W-2 employee of your company, draw a paycheck, and then also take a profit distribution on top of that. And by doing so, there are many advantages, including you're going to minimize your taxes, and you're going to certainly increase your access to capital. So in financial management software like QuickBooks, and again, we have no affiliation with QuickBooks. It doesn't matter to me what you use, but we can support you best if you're using QuickBooks because we understand it. more than others, but software like QuickBooks is easy to organize, complete daily accounting tasks, create reports and statements, help you track the financial health of your business. And so the truth is you could do this, or you could outsource it, the whole buy or build discussion. You could have a bookkeeper or an accountant do these activities for you. But regardless, we need to have financial management software. And it's not expensive. And for instance, QuickBooks, you used to go buy QuickBooks on a CD and put it in your computer. Now most software is cloud-based. I think QuickBooks continues to offer an initial period of time where you can have the software at no cost, a free trial. All right, financial statements next. Reports about a business's health and cash flows. We talked a bit about this a moment ago. These are important. You can't make the excuse, oh, I'm a startup, or this doesn't apply to me. 3 types: balance sheets, cash flow statements, and profit and loss, sometimes known as P&L or income statements. I'm going to briefly show you examples of each of these as we go through the lesson today. But ultimately, the power really isn't at looking at others. It is using financial software, like we just talked about, and producing your own, and managing and strategizing and planning based upon your data. That's the most important. Excuse me. So on balance sheets, you can see in pages 10 through 13 of your participant guide, some examples there. And again, your mentor will sit down and walk through this with you. I used to teach accounting, so I could give you a lot of detail, but just at a high level, there is an accounting equation: assets equals liabilities plus owner's equity. And on a balance sheet, with this very simple example, you can see assets, which are things that you own that have value, on the left, and then they're totaled up to $55,000. Liabilities on the top right, that's money that you owe. And frankly, the difference between what you own and how much you owe in your business determines your owner's equity. On the right-hand side of that equation, again, if you add liabilities plus owner's equity, it must equal the same as the total value of assets. What should have happened from module 2, and if not, you really have to get with your mentor because we're not on track, is we should have done a personal financial statement at the end of module 2, which follows the same concept, but that was for you as an individual or as a household. Now we're talking about those concepts for your business. So again, I'll let you work with your mentor on doing these different discussion points, but on page 12 of your participant guide is a balance sheet, and you'll want to sit down with your mentor and kind of play the role of consultant or advisor or educator, and use that as a skill developing process to make sure you understand how to read a balance sheet. Next financial statement is cash flow statement. Has 2 definitions, the first of which is cash received less the amount paid out over time. It's cash moving in and out of a business. This is really important, and I'll give you a quick example. So let's say that you and I are going to work together on getting funding for a brand new startup. And so we're just going to say it's going to start January 1st of the next upcoming year. And so will January be profitable? Well, January might be a profitable first month for us, but will we have positive cash flow? Because we might make sales, but we don't see the money come in yet. There might be a delay, or the expenses might start being incurred before the revenue starts coming in. And so managing cash flow is important. Projecting cash flow is crucial in determining actually how much capital we need to borrow to make sure that we don't run out of cash. So a cash flow projection is a financial statement using assumptions to forecast cash coming in and out of the company, future cash flows during a specific time, and whether we'll have enough money coming through or are we going to need to supplement it. How can a cash flow projection help, and when do I need one? We need one to set sales and expense goals, to determine our break-even point, to plan equipment purchases for replacement or expansion, and determining cash needed to purchase inventory for seasonal cycles. And When we are doing the financial projections for your business, which is back from module 1, using the software for both the business plan and the financial projections, it's very rare that a business has very steady income. There's almost always some seasonality factor. Retail does a lot of their business in the fourth quarter of each year around the holidays. Pool companies may be the opposite, right? They have a lot more business in the spring and summer as people start thinking about wanting to buy a pool or upgrade or maintain their pool. So almost every business has some seasonality, and we need to be able to project accurately the financial impact of that. With the question here, how can a cash flow projection help? When do I need one? We want to track liquidity when accrual accounting makes reality. So there's two types of accounting, cash accounting and accrual accounting. I'll just simplify. Cash is recognizing income and expenses when they actually occur in terms of the cash flow hitting your account. Accrual is recognizing, is booking those revenue and expense items when they're committed for. So let's say you and I own a landscaping company, and we go out and we're trying to sell services to mow yards, and our first prospect says, yes, I'll pay you for the whole summer. And so they pay us for 4 months worth of lawn care. Well, if they paid us all, then we would book that. But if it's accrual, we're going to actually spread it out. Or alternatively, let's say they committed to 4 months of lawn care, but they didn't pay us yet, but they signed the agreement. Well, in accrual accounting, we would show that as a sale, even though the cash flow hasn't come in yet. Bullet 2 is helping you determine the need for financing. And number 3, it's great for external parties, so they see, like lenders, the money that you expect to come in and how that's going to help service the account. Because it's not unusual that we want to access capital to grow a business. That kind of makes sense. Well, we need to be able to demonstrate that if we were able to borrow, let's say $100,000, what impact it would have to our future profitability and cash flow. And if it doesn't help, then the lender probably wouldn't want to make that loan because they're just taking the risk. There's not an increased benefit to your business. So in a cash flow projection, there are 3 main areas here: sources of cash, operating uses of cash, and non-operating uses of cash. And again, I'll leave this for you and your mentor to sit down and go through the page 15 project in your participant guide. All right, so that takes us to the third and final financial statement we're going to visit, because we've talked about balance sheet and cash flow statements. Now we're talking about profit and loss, often called income statement. It's measuring revenues and expenses over a period of time, and it helps us understand if we're profitable or not. Shows how successful we have been in the ability to grow, repay, and service debt. As stated here at the bottom, the profit and loss is the most important report from your accounting software program. And it's also going to impact your taxes, isn't it? There's a formula for profit and loss, like there's a formula for these other financial statements, and it's sales minus cost of goods sold. Now let's dig into that. So the acronym for that is COGS, C-O-G-S. So if you and I are selling t-shirts, then we're buying the t-shirts and reselling them. A lot of us are in the service industry, so it's called costs, C-O-S-S, cost of services sold. But regardless, it's sales minus those expenses equals the gross profit, and then we have our general overhead, and then at the bottom line, we have net profit. What's the number one goal of any business? It's to generate profit. If it doesn't generate profit, it won't succeed, and it's probably not worth your time. It would be considered a hobby with it. So the basic formula for profit and loss, net profit is the bottom line. That's what's going to allow you to be able to draw profit distributions or an owner's draw if you're a sole proprietorship. It's going to be able to help fund future expansion and equipment, allow you to pay back loans, and of course, it's going to generate your taxation. Is it hard to generate these financial statements, including profit and loss? No, it's very easy if you're putting your data, your revenue and expense items properly into accounting software like QuickBooks. So you'll sit down with your mentor and do discussion point number 4, which is page 17, kind of breaking down the P&L of a business. So this is a really hands-on module. So again, don't be hesitant, don't be afraid to get your appointment scheduled with your mentor and go through these activities so you truly understand these concepts that we're talking about. And then we're going to be turning around and applying it to your business as well. All right, moving on past the 3 types of financial statements. Now we're on to business financing. What is business financing? It's getting the money you need to start, operate, or grow your business. There are 2 basic types of financing: debt versus equity. Debt is where we're borrowing money and we promise to pay it back. And it could be a loan, it could be a line of credit, it could be credit cards. Equity is where yourself or someone else is injecting money in, not expecting to be paid back as a debt repayment, but hoping to share in the future profitability of the business. And then the second bullet there is understanding the difference between financing working capital versus fixed assets. So if what we really need is money just to hire employees or do marketing, so it's money that we burn through and we don't have tangible assets left over. Hopefully we generate sales and income and profit from the expenditures, but we're not buying things, we're just spending money. That falls into the working capital budget versus fixed assets. We want to buy commercial real estate. We want to buy residential real estate to fix and flip or buy and hold. We want to buy equipment. We want to buy a company vehicle. Those are all examples of fixed assets. The financing plan differs for those 2 different types of uses of funds. And back in lesson 1, module 1, part of the financial planning process that your mentor helped you with is breaking down how are you using your funds. So that should have been delineated, almost like a shopping list of how you're going to use your money. When I say use your money, use the money that's you're borrowing or getting investment from investors to invest in you. Okay, so what are some do's and don'ts of small business financing? You do want to put your own money in. You want to have skin in the game, and that's going to give others more confidence. You need to earn the right to borrow. We'll talk more about that. We do need to show profitability. A lot of small businesses will take the mindset, well, I don't want to pay taxes, so I'm going to write off everything. And sometimes they get very aggressive in that. And then when we're not showing profitability, then that weakens our borrowing capacity, weakens our access to capital. We need to understand and keep working capital. We don't want to be operating off of fumes. And so whether it be 1 month or 3 months or even as much as 6 months of expenses, having that in your business bank account. So if there's a slowdown or another pandemic or whatever may happen, that we have survivability, that we're not insolvent. Be lean on fixed assets. And what that means is when we buy a lot of real estate or buy a lot of automobiles for our business or equipment, we're going to have to make payments on those, of course, until they're paid off. And so those payments, just because revenue has gone down or dipped, don't go away. And we need to match sources and uses of funds. And so what you'll see is that's why, again, in module 1, we need to understand how you plan on using the money. Because let's say that you just needed cash for 60 days for a marketing campaign. Well, even using a business credit card for that might not be a bad idea, because we can get often 0% interest on business credit cards in the short term and pay it back before there's any interest expense. And it's short-term use, short-term payback versus going out and buying a commercial property on a big business credit card you may have. That's not really matching sources and uses of funds. That would be better off to go get a mortgage on and then have 10, 20, 30-year repayment terms because of the useful life of that asset. We need to understand our financial statements, which we were talking about a few minutes ago, understand different collateral options. And collateral in brief means, what are you pledging that gives the lender or extender of credit confidence that if you don't pay them back, that they're not going to be stiffed. And you're going to actually be working here after module 3 with your mentor, whomever they assign you to set up a collateral assignment. So there's different types of collateral. One of the most popular is what's called a key person policy. A key person policy would allow that loan or that debt to be paid off so the lender or the extender of credit doesn't have exposure in case the borrower should die. Because they can underwrite the loan or the extension of credit to you based upon you being around. But if you're not around anymore, then who's going to take over the business? Who's going to pay the debt back? Is the business going to continue to even operate? So there's different types of collateral. Key person policies is a part of a well-designed loan package, and your mentors could be helping you with that after this lesson. And then you need to understand the risk and cost for different types of capital. So getting ready for a loan, we need to have a business plan and a profit plan, and that, if not complete, should be well underway. We started that in module 1. Number 2, we need to know what we can afford. And so that is also derived from what we've learned today, but what we put together starting in module 1 with our financial forecast. We need to study our financial statements. And so we first need to be able to produce financial statements. So if we're not using QuickBooks or some sort of financial accounting software, we need to start doing that. We need to import our data in, and we need to be able to produce financial statements. And we'll be asking you for those after module 4, because it's going to be part of your loan package as we get ready for funding. We need to check our credit report, both personal and business, and we talked about that pretty extensively on module 2, didn't we? We're going to need to establish collateral options, and again, your mentor will be getting with you after this module to get that key person policy set up. We need to show your equity contribution. What have you put into it? And that's an interesting one. When I worked for the SBA, I learned a lot about the equity contributions. And so let me summarize. Some sources of capital, some lenders want to see documented evidence that you have equity contribution. And frankly, some sources of capital don't. Some are so specific, they want to see what cash you've put into the account in the past 6 months. Well, often we're putting money into our business, but we're not tracking it properly. And so again, that's why the QuickBooks is really important. QuickBooks or software like QuickBooks is important to track the investments that we're making into our business. So let's use an example. Let's say that we're early on, we're pre-launch, but we need to buy a laptop. Well, the smart thing would be, I believe, is to, if you don't have enough money in the business account to buy the laptop, wouldn't be to go buy it yourself as a personal expense. Instead, you can make an equity, we'll just say, make an equity contribution of $1,000. So go put $1,000 into your business checking account, code it as an equity contribution, and then use your business money to go buy the laptop. The IRS is going to like that because that's going to be considered most likely fully tax deductible, and you just showed $1,000 equity contribution. Alternatively, if you didn't do it that way, you just went and spent used your own money to buy the laptop, and then now what are you trying to do? Give the laptop to your business? It's just not as clean. And number 7, and we're going to help you do this after you complete module 4, is research your financing options. We're going to put together a capital acquisition plan, CAP for short, and we'll be working with you on financing options once we have this data set together. So what are common elements of a loan package that we're going to be helping you build? Certainly the business plan, the financial statements, both business and personal. If there are tax returns. Also, there's some other items that's not listed there, but we'll continue with their list, and I'll add a few elements here in a moment. We need to be able to show sources and amounts of equity contribution or credit reports. The collateral, like the key person policy, we'll actually include that in the loan package. If we're looking to buy or build, including specific documents that show what we're going to be spending money on. We have a client that we help. He was a very successful auto mechanic. I guess he is still, but he worked for a mechanic shop. He made about $100,000 a year, which is great, but he wanted to spin off and get his own business. And so we were helping him with that, putting together the loan package. And in his case, what we did is we went, excuse me, and got letters of commitment from some of his fleet clients that he had been working with that was going to follow him to his new business. So there can often be additional documents or resources added to the loan package that increases the strength of the package to give the lender or the extender of credit even more confidence in where you're going. Qualifying for a loan. What are the criteria? Well, the first thing we need to disclose is different sources of capital have different underwriting criteria, so there's not one set answer. But here we'll follow the slide. So it says a good credit score. What is a good credit score? In general, we need to have around a 160 or above. Again, business credit scores go from 0 to 300. If you're not sure where yours is, we can help you with that. So normally we're looking at FICO SBSS as the scoring model. It goes from 0 to 300, 160 or above could be considered usually good enough. And that is calculated based off of a number of factors, but we'll help you with that. Equity contribution, and that's true and not true. Not all sources of capital care if you've contributed equity, but some do. That's why it's listed. Certainly your ability to repay. If you remember back on module 2, we talked about the 5 C's. And one of those C's was capacity, they called it. We call it cash flow. Well, it's tough to go borrow money if it doesn't look like we can afford to pay it back. And we see that sometimes. I don't know if it's desperation or if it's financial illiteracy, but some people some clients will come to us and they have no ability to repay, but they want to borrow money. Well, the truth is there are some sources of capital that do not verify income, that do not verify solvency. So there can be a workaround, but in general, if you can't afford to repay it, you probably wouldn't want to borrow it. And then there's loan to value ratio. What are financing options? So equity, and we talked about that earlier, equity is where we're not borrowing money, but instead we're getting an injection. And it could be we injected our own money, it could be friends, family, it could be investors putting money in because they believe in the model and they want to share in future profits. I know that one of my early endeavors, that's what I did. I had gone to a business function, met a CPA that owned a big staffing firm, and I was able to raise right about $500,000 from him as an equity contribution into this early stage business model. So don't overlook the fact that equity injection is real. There are a lot of people and institutions and organizations that have capital that are looking for places to invest, and high growth small businesses can be attractive. Secondly, sweat equity, and that's where you're putting the time and effort in, not getting paid, but foregoing expenses. So maybe you're not drawing a salary right away because there's not money to cash flow it. So you're contributing to the business, but not yet becoming an expense. Business credit, we talked about that in module 2, and raising $50,000, $100,000 of business credit under the EIN is completely doable. It's just a process. We talked about how business credit always works. It's faster than building personal credit, and you can get more business credit than you can get personal. So that is a good option, as well as family. But ultimately, what we're going to typically do is go through these 4 modules, build a loan package, and then go out to the capital markets, find out what the right source or sources of capital would be. I think the point here really is what are some alternative financing options to what you may have considered already. So some key points to remember as we start wrapping this up. Financing is getting the money you need to start, operate, or grow your business. We need to secondly start with a budget. Sound bookkeeping is the basis for all financial management. We need to get QuickBooks or something like that and start using it. And your mentor is going to be helping you with that here after this lesson. There are 3 important financial statements: the balance sheets, the cash flow, and the P&L, often called income statement. That's important, that tells the story of your business. We need to separate our personal and business records and funds. And then there are a number of factors that impact your ability to get a loan. But most importantly, we said this so many times, different sources of capital have different underwriting criteria. I think that's where the most common mistake that we see entrepreneurs make is they don't assimilate that. They think, oh, I don't meet the criteria. Well, maybe you don't meet that criteria, but maybe you meet a different criteria for a different type of funding, and or what can we do to meet the criteria? So maybe we need to take stair steps. Maybe we won't go get $1 million right away, or whatever that dollar amount is you need. Maybe we have to stair step it. That's not uncommon. So in conclusion, just one more slide after this one. We talked about what financial management is and why it's important. Hopefully you're going to work with your mentor and do those different exercises so you don't just listen. You can actually apply what you've learned in terms of the case studies. And then ultimately we need to apply it for your business because we're going to need this for your loan package. Secondly, we talked about some common financial management practices, rules, and tools. We talked about startup financing, financing a growing business, financing working capital, financing worked assets, fixed assets. All right, so wrapping this up then. A great job on completing module 3. We only have one more module to go. You do want to get with your mentor, work on these exercises, preferably, but certainly go ahead and start working on your collateral assignment, that key person policy. And they're going to also most likely work with you to create an FNA, a financial needs analysis, and that's used to calculate how that key person policy would be set up. So thank you so much for your time. I'll see you back here soon for module 4. We'll be getting this wrapped up here soon and getting your file ready for funding. Thank you. Talk to you soon. Bye-bye.